Mahesh Nandurkar, India Strategy with CLSA. Mahesh, I loved your headline from fiscal discipline to growth and from consumption to investment. How soon do you think this will happen? What are you telling your clients? Buy now, because this is the last bell. If you miss the bus now, you will miss it for a long time.
Well, yeah, so it's finally good to see the smiles coming back on the faces of fund managers and the stock market players. So talking about those 2 points which you mentioned, from a tight fiscal stance to a pro-growth, I think that's clearly a big change that one must acknowledge, and I would definitely welcome that step, because the economy clearly needs a growth push, and a big bang push like the one that the government has given on Friday is really welcome. The second point is also very clear, the direction in which the government wants the economy to grow. It's clearly investment, because if consumption was really the end motive, they would have easily taken a larger cut on the GST, but they have chosen to cut it at the corporate tax level rather than the GST level. So that clearly shows the direction in which the government wants the economy to move. And frankly speaking, we have seen a large move on Friday, somewhat a move like today as well. But that just takes into account the potential EPS upgrade. So at a market level, very simplistically speaking, we were looking at about 7 to 8% EPS upgrade. Obviously, it's a function of what the companies actually end up doing, whether and what kind of benefit do they pass on to the consumers, or they invest back to drive growth, etc. But at the simplistic level, it's about 7 to 8%, and which is what the market reaction has been so far. But I still feel that a big change in the sentiment it's still not captured in. So what we have captured in with the last 2 days move is the EPS change, but the PE change, which I believe is also warranted, hasn't happened as yet. So there is clearly some more upside here.
Mahesh, can you identify the next set of gainers for us? Do you think the mega caps will continue to outperform, or now it's time to take a deep dive and say that, look, corporate India will take a risk, and when you think corporate India will take a risk, you need to take a risk in your portfolio, which is add a little bit of beta, maybe a lot of cyclicals, and throw away some of those mega expensive names like Asian Paints or a Britannia, or for that matter Bajaj Finance. Do you think we are at that turn where portfolio approach needs to change?
Oh, certainly. I would definitely feel so. I clearly feel that we have seen the consumption stocks doing pretty well over the last 4-5 years. My own sense is that the consumption as a share of GDP has peaked out, and investment as a share of GDP is at the bottom, and from here on it will be going up. So clearly I would like my portfolio to be more skewed now in favor of the investment cycle plays, so which is something that I would like to play through the capital goods names, some of the infra names, the lenders, which is basically the corporate sector banks, mostly on the private, but one can take a selective bet on the state-owned banks as well. Clearly I would probably also like to take a look at the four-wheeler space, because that's the space which has got kind of battered down. On the low ticket consumption items, I mean, I have seen the stocks doing pretty well. But that also shows at this point in time that the risk appetite on the domestic investment cycle is still not back. The investors are still looking at buying some of those expensive names as we speak. But my sense is that the time has come to take a look at some of the names on the investment side.
Just wondering, I mean, I know I would sound foolish talking about anything like this, but definitely this corporate tax rate cut comes with its share of a fisc burden as well. Along with that, how is it that you now see RBI moving? Because we had seen an easing scenario by the RBI. Could that get challenged now? Could the RBI go status quo or even hike rates perhaps?
Well, I would say that the RBI's policy outlook, which is primarily based on inflation, as we now know, which is the legislative change which was done a few years ago. So I think RBI is going to still base its monetary policy on the basis of what it feels is going to happen with inflation. And my view is that the CPI inflation trajectory is unlikely to change with what has happened like yesterday. My sense is that the inflation in India is still at a structurally lower levels. I would still say that the CPI outlook will be between 3.5 to 4% type of a number. And the reason for that, I think I have explained, on your channel as well. I mean, our own, detailed work that we had done late last year shows that the farm productivity in India has improved significantly, and that's the key reason why the food inflation is low, and therefore the broader inflation is also at a lower level. So if we go by that assumption that the CPI is going to be between 3.5 to let's say 4% type of range, I still feel that there is enough room for RBI to cut rates. My personal view would be that I'm still expecting a 75 to maybe even 100 basis point type of a policy rate cut.
Okay, so in light of that, Mahesh, financials, of course, top of your radar. Would you be willing to perhaps expand the basket at this point, or would you continue to just build positions when it comes to some of those frontline names I know you like?
Yeah, so financials definitely one space that we like, but within financials, what we have been looking at is also the non-lending financials, as well. So within that, the life insurance companies do not really get any benefit out of the corporate tax cut, but the non-life insurance companies, the general insurance companies, definitely get a significant benefit. So that's an attractive part of the portfolio as well. And as you know, we continue to stay quite optimistic on the housing market recovery. So with that, the leading mortgage company as well as the property developer, that space we continue to like. And my sense is that while the government has announced a big bang policy announcement on Friday, but that may not be the final word, and I'm still hopeful that something might still come out on the housing side.
Disinvestment is the other thing, Mahesh, at least that we also are picking up, that the government has formed a roadmap. There's lots of talk on which route the government is going to take. Is it going to be out and out privatization? Is it going to be a merger of some of the energy companies into one? Would you find any investment themes out of the entire list of PSUs under the government's umbrella?
Well, I think with this, completely out of the blue on Friday, one thing is for sure, that the government's focus is clearly there on reviving the economy. They are clearly not afraid of taking bold steps. The Friday step was clearly, I would call as like one of the boldest steps that the government has taken. So in that context, I would say that strategic disinvestment, within the PSU space, something that I would have attributed a low probability to till a few days back, now I think becomes a high probability event because clearly the government's intention. The second thing is a strategic disinvestment will also help the fiscal, because while the government has given this large bonanza, it would still be mindful as to how to minimize the impact of this on the broader fiscal. And if the government were to undertake strategic disinvestment, that clearly improves realizations much more. And that definitely is going to be one of the themes. So I think what we'll need to watch out for is what are the possible candidates under that space, which can undergo that strategic disinvestment side. There could be a few names on the energy side, on the gas transmission side, on the oil marketing side. So that space now begins to look more interesting. Within that, I would probably say gas transmission looks more interesting.
Let's say a question in terms of PE re-rating. It cannot happen in consumers. It cannot happen in staples. It could happen either in private sector capex dominated companies like the L&Ts of the world, or it could happen in gas transmission or oil marketing companies, which are PSU. So where do you think there is scope for PE re-rating, PSUs or private stroke cyclicals?
I think select PSUs, yes, but clearly, given the investor experience over a longer term with the private companies versus the public, my sense is that I would still consider it, safer to, go with the private banks and a few other companies and few other sectors that we've already discussed. But yes, select PSUs, also begin to look interesting, as I mentioned, on some of the names, which can be the disinvestment candidates, the strategic disinvestment candidate. Let me kind of rephrase that, and also, some of the large state-owned banks.
Okay. Mahesh, what are the chances that whatever excitement what we are currently experiencing, both in terms of mood point and also on the stock market screen, it may just be short-lived? And I'm not talking about domestic factors. Crude is on a boil, trade war fear are real. The 10-year paper in US has started, if I may use the word, misbehaving, because there's a very sharp uptick and downtick. So whereas India may be a great story, not on paper but also in theory, but the global cues may completely ramp it down. I mean, the reason why Indian markets fell in the month of July and September was not because of slowdown, because FIs had compulsions to sell.
Oh, absolutely. So I think we have to be mindful that we don't go overboard, because ultimately the impact of what we have seen over the last over the weekend Friday has the possibility or has the capability to take the markets up by, say, about 10, maybe 12% or so. A large part of that has already happened as we speak. But over a medium to longer term, what happens globally definitely means a lot. And I would essentially be watching out for two events here. One, as you rightly alluded to, the possibility of the US-China trade war, which way it is going to move. My sense is that is going to be a big driving factor behind the FI flows in or out of the emerging markets in general, and therefore in India. While the news flow seems to be there on both sides, whether it's going to worsen from here or improve from here, but I would say that given the fact that we are heading into the US election, which is about a year from now, and my sense is that there would be keeping the political situation in the US in mind, I would say that there's a greater probability of some kind of easing of the trade war tensions between the two, rather than the other way around. So I would say that could be a positive factor going forward. Second important factor to keep in mind would be what happens to the rate cut expectations in the US. As of now, the market is broadly factoring in one more rate cut by the US Fed in the current sort of calendar year. But if the commentary over there changes, or if the US economic growth begins to show more signs of weakness or worry, then the market will begin to think that there is a possibility of more US Fed rate cuts, and therefore there will be a possibility of US dollar weakening. Now, that kind of a situation will be ideal for inflows into the emerging markets, Asian markets, and of course India. So yeah, that I think remains a factor. As of now, there is no clarity. The investors kind of believe that the US dollar direction is not really very clear. It could move either ways. But my sense is on the former, the US-China thing, there is more possibility of easing rather than worsening. So from that perspective, I would say that my view on the Indian markets with a 12-month view would still be optimistic, and I would be looking at a further 10-12% kind of returns at the broader market level over the next 12 months, and certain sectors that we just discussed could actually deliver much better returns.
Mahesh, is there scope for autos now to come back? Because sentiment surely has changed, rates have come down, the base effect would kick in. There's just too much of pessimism in autos. Now that there is clarity on GST cut, that GST cut is not coming, I mean, the buyers who wanted to buy the car, they will also start buying it. So do you think a 15-20% move in four-wheelers, maybe a 10%, 12% move in two-wheelers is coming?
Well, possible, and the factor that you mentioned, that now the potential buyers will begin to believe that there isn't going to be any GST cut on autos, so that could bring back the people who would be sitting on the fences. And also, as we go forward into the December quarter and beyond, the base effect will begin to be more benign, and therefore the YOY growth numbers will look much better. But if you will ask me whether I'm going to go all out into the autos at this point in time, my answer is going to be no, because I don't really see any kind of fundamental improvement as such beyond the base effect and all that. But I don't really see any fundamental improvement as such, especially in the near term. So I would still advise that the investors should take a slightly longer term view of 12 months and beyond, and should still be focusing more on the investment plays, such as the banks, the housing market, etc., rather than to go with the sort of the consumption plays. Yes, select auto names can actually rebound. There is always that possibility, but I won't really be buying those names with a longer term view.
On 18 ounce only, hope to see much more of you going forward.